Okay, what is up, traders? What's up, tycoons? Is Christmas coming early? We have to talk about the market melt up theory, and we're going to go over some really, really important data that you want to pay attention to. Right now, I don't care if you're a bear, this data is still going to be very impressive. All right, and we're going to go over that, break it all down in today's video. It's going to be an absolute banger. Has Papa Powell potentially turned into Santa? And, is the CPI numbers, is the PPI numbers enough to really continue momentum up for the rest of the year? But as always, the content provided on this channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And seventh time a charm. Now, what is the seventh time that we're referring to? Lucky number 7, hopefully. These are the times that the market has believed that there's a dovish pivot from the Fed. Now, the Fed has maintained its higher for longer policy and sounds like a broken record, continuing to just say so and say so. And what we're looking at is treasury yields here. And there's been 6 other times here where people have thought that, okay, well, now something is broken, something is happening, and the Fed is going to be basically having to do a dovish pivot here and potentially start talking about rate cuts. Again, we're at that point again. And the market thinks, currently at the moment that we're going to start seeing some more rate cuts sooner than expected, right? And basically saying that Powell is bluffing with the whole higher for longer. Now, what's a reason for that? Okay, well, if you take a look here, all right, and we take a look at the treasury yields, and we take a look at the Fed fund rate. Okay, so we have our Fed fund rate in blue here. We have the 10-year yield. All right, and once you see this get above the 10-year yield, that is typically when you start to actually see rate cuts, right? And I've went over this in the past. I've had a whole dedicated video, but I just want to revisit it again for you guys. Take a look here, right? Fed fund rate in blue is above the red 10-year, right? And that's when we start to see the cut. Okay, same thing happens over here. Fed fund rate is above the red line, okay, and that's when we start to see a cut. Now, what happens usually afterwards? These gray shaded areas, these are recessions, okay? Over here, Fed fund rate above the 10-year treasury yield, we pull back, recession, okay? So it's very possible that people don't realize that the Fed rate cuts, it may not actually be something, you're truly actually looking forward to if it's going to end up leading to a recession. Okay. So, do keep that in mind. If we take a look at where we're at right here, the Fed fund rate is still below the 10-year treasury yield, but if yields can continue dropping as they recently have, okay, then it's very possible that the Fed fund rate, if they keep it higher, will get above that 10-year treasury rate. And oftentimes that's a sign that the Fed is going to start cutting rates very soon. Now, the soft landing hopes and hard landing realities. Okay, these are the number of news articles mentioning a soft landing. You can see it acts just absolutely skyrocketing here. Okay, and then we have U.S. recessions here in gray. So what do you see? Well, we see it skyrocketing here. Everyone's talking about a soft landing. Very shortly afterwards, recession. Same thing over here. Soft landing, huge recession afterwards. And now we're at this area again where everyone's talking about a soft landing. And we just kind of went over how it's very possible we could be getting a recession, in the future. Now, is this bullish though, right? Is all of this bullish? I thought that's what the point of this video was. Well, let's get into some of that data. So if we take a look here, we have hedge fund positioning and mega cap tech is now back at record highs. This is the basically the share of total U.S. hedge fund single stock net exposure. This is for the Magnificent Seven. Okay, it's the highest it's been, back at record highs, as we mentioned. And, everyone keeps saying that it's only 7 stocks taking the market up. Well, if that is the case and, these 7 stocks are going to go up and these hedge funds are in these stocks, that's going to result in the market continuing to go higher. Now, let's talk about this possibility for a melt up, okay? November's been pretty bullish. What we're going to take a look here is at pre-election year data, okay? And this is for the month of November. So we're here now at the 18th, so right around this time period here. And you can see that this is usually when we start to get a little bit of a pullback, a little bit of a cool off, And then look how bullish the end of November is. Nvidia's earning is next week. Okay, so this could be a factor that actually helps play into the seasonality. If Nvidia comes out and beats earnings and sets another crazy guidance, okay, for the next quarter and for next year, you better believe that the market is going to go into bull mode, right? And that could potentially cause the launch here that we're looking at and that we've seen historically in pre-election years. If you take a look at the S&P 500 performance before and after a daily winning streak ends, and so this is after a 7-day winning streak, an 8-day winning streak, and a 9-day winning streak, which is what we just went on here recently. Look at what happens: a slow melt up, right? So you have the dramatic rally ahead of time, okay, and the push higher, and then what do you get? Just a slow melt up, right? A slow melt up, nothing crazy insane, but ultimately very, very nice, going up another 2 to 3%, oftentimes is many of the case, right? If we take a look here, this is the NASDAQ. Okay, so we have the NASDAQ currently right here in purple, and then in green, look at this absolute face ripper. Okay, I mean, this is a rip your face off rally right here that the NASDAQ had. This is back in 1999. Okay, so the green line is 1999, the blue line is 2023. I mean, let Nvidia come out with crazy, amazing earnings. Let everyone think that the Fed is about to start cutting rates and going bullish on the market. It's very possible that we could just see, something like this. Now, do I think it's the biggest case scenario? No. But I mean, look at this absolute melt up right here, just, absolutely skyrocketed. And, we're tracking very similarly, the NASDAQ is, to how it traded back in that year of 1999. Obviously, we know that's right before the 2000 .com bubble. But we're living through the AI bubble right now, and that bubble is still forming, okay? People are still trying to figure out how to evaluate AI and how to truly put a value on it. And that's how bubbles form, okay? Because nobody knows what the true value is. They're all speculating on the value, and the bubble just keeps getting bigger and bigger and bigger until one day eventually it bursts, right? So if those charts and that data wasn't good enough for you, let's talk about some things that really could drive it potentially. Well, if you take a look at institutional investor cash allocation, it's near 25%. Okay, it's about 20%. And so, a lot of these hedge funds and a lot of these institutions, look at how the Nasdaq has been performing this year, right? If they've just been in treasury bills or if they've been in defensive stocks, they're massively underperforming tech right now. And so, getting closer to that end of year time frame, right? A lot of clients are going to be coming to these guys and saying, "Hey, how come my portfolio is only up 8%? How come we don't have Nvidia, right? How come we don't have more Nvidia? How come we don't have Meta right now? How come we don't have Tesla? Whatever it is, mostly going to be Magnificent Seven stocks." And so these hedge funds, to try to save face, essentially, are going to be chasing a lot of these big names and have been chasing a lot of these big names. And as we see, there's still a lot of cash allocation in institutions right now. And so as that cash declines, you'll see it actually go into the markets, right? And we saw in the very beginning that, a lot of these institutions are back at the largest and record highs when it comes to net exposure to big tech stocks in the Magnificent Seven. If you take a look here at the cumulative returns from July 1981 through September 2023, the reason we're showing this is because we went over a chart saying, basically just showing, something that could potentially fuel this melt up, right? If you take a look here, everyone's obsessed with money market funds right now, and that's all people are talking about. But if yields have peaked and yields are going to start dropping, then it's very possible that people aren't even going to realize that they're losing money now in their money market funds. Not necessarily losing money, but that the yield is changing, right? It's going to go from 5% to 3% very quickly. And then they're going to look at the stock market and say, "Oh, well, man, look at the stock market. It's up 18%. It's up 20%. Etc. I need to chase that now, right?" And that's what's going to happen, is a lot of people are going to pull money out of those money market funds and then pull it and put it into something like the S&P 500, put it into those Magnificent Seven stocks, etc. Right? So we see lots of institutions have cash on hand right now. We know lots of individual investors. We've taken a look and we've shown the massive amount of inflows that money market funds have received. And this is the cumulative returns, right? And if you take a look here, the S&P 500 over time is going to outperform every single time when it comes to an aggregate bond index, a money market fund. And so that money is eventually going to come out of those money market funds and go back into stocks eventually, I think. Now, this is one of my favorite charts right here. And so recently on that CPI day, 90% of stocks in the market were green, essentially, right? And so there's actually some really interesting data right here. If you take a look, after stocks were up 90%, or basically after 90% of all stocks were up, if you look at the statistics right here, the 30-day average return is up 3%, and the 65-day average return is up 5%, right? So again, that gives us a market melt up for the end of the year. Nothing crazy, okay? 3% in 1 month is very good. I mean, that's 36% annualized. But we're not going to see necessarily, maybe another 15% or another 20%, at least by this data. But again, this kind of helps reinforce that melt up theory, right? I mean, if you take a look at the time, all right, 30 days out after 90% of all stocks have been up on a single day, that's bullish, right? It's positive. It's up 3%. And so that is a very, very good statistic right there. And I mean, when 90% of all stocks go up on a single day, I mean, that just screams bullish, right? I mean, that's definitely not something that's bearish right there. Yeah, it maybe have been a little bit over exaggerated, with the CPI, and as a result of CPI. But at the end of the day, that's screaming bullishness to me. And so that's something that really has me hesitant to, overly short this market or try to aggressively short this market. You don't want to be on the opposite end of a melt up or a meltdown. And there's lots of data here that we've went over in today's video suggesting that we could actually get the melt up. If we take a look at the SOX ETF, this is your semi ETF. Take a look at this right here. Now, to the untrained, average person, they might not tell what's here, but this is very bullish. Okay, this candlestick, this candlestick, this candlestick. Comment down below if you guys know what this chart pattern is. Right, we'll actually take a look. Okay, and this is a 3 white soldiers. Now, this is a weekly chart. This is a weekly time frame. You can see we've broken the recent downtrend, right? If we were to just draw a simple trend line here and just do something a little bit like this, right? Clearly broke that downtrend. And now what do we have? Well, we've got 3 white soldiers. Okay, very, very nice to see. Very excited to see that. Right, it's this candlestick, it's this candlestick, and this candlestick. The way that those are shaped, they are forming this 3 white soldiers chart pattern, which is a bullish chart pattern, and suggests that we are potentially going to get further room or a further rally to the upside here. So when you look at data, when you look at charts, when you look at cash, when you look at positioning, and then when you even look at the technical analysis and just some simple chart patterns, it's all looking very bullish at the moment. We'll see how it will play out at the end of the day. We don't really necessarily know, but I mean, just take a look at even the chart here, right? We break the downtrend, 3 white soldiers, and then we get continuation to the upside. So, that again, that doesn't have to happen. No chart pattern is 100% guaranteed, but we have taken a look, and 100% of the time, the market has been up 30 days. From basically last Tuesday, that day when we had over 90% of all stocks in the stock market were green. So that's basically it for today's video. If you didn't know, I started a free newsletter, Investment Intelligence. You guys can sign up for that using the link in the description, giving out free trade ideas straight to your inbox every single week. Or you can join the Investment Intelligence Discord. There's also a link in the description for that one too.